We're going to go over a couple of things today. We have a couple of handouts. We're going to go over the main thing today is going to be a new chapter on partnerships. Partnership Accounting, Chapter 14. 14? 1-4. 1-4. Yeah. We're moving into the upper levels of the book. We're just finishing and the good news is that we're still going to go over 10. And we're still going to go over 10 right now. So we're still going to do that. What else are we going to talk about? So I wanted to show you this thing that I did for you. You got an email regarding you being registered in a class. What that is regarding eCollege is this console over here. This is the Rutgers online learning system, eCollege. This is apparently the way of the future.
I got an email that said that I signed up for financial.
Yeah, it's not really. They just copied my other course because that's how they do it. They always copy the other course. But now, if you click on it, it says Advanced Accounting because it's the right course. And now, if you click on it, it's already updated. Like in a way, I'll tell you guys what's going on. Sorry about the confusion, because you guys got the email and you were thinking like, do I have to pay for it? No, you don't have to pay for anything. So the idea is like, what are we doing here? This is how the Macy program operates. In a way, if somebody's interested in the Macy program, I teach a class there. This is your teacher in the Macy program. It's a screen with stuff in there. It's like a computer. So I work with this stuff. I've been working with it the last couple of years. The reason I like it is because, in a way, there's something there that I really like, because this is HTML code and you can embed video within the HTML together. So it's in a way like, I want to see if I can build you guys an exam review using stuff that I write out here, examples, and also the video discussing the same example. So this is like an exam review for you guys. If anybody was able to log in there and see it, you can if you want to. So this is it. That's part of that. The handouts are there if you need them. What else? It feels like a holiday on campus. Sounds like you guys have big plans. Sounds like people have big plans tonight. Tomorrow night, tonight. So we're going to go over Chapter 10, summarize Chapter 10 just like quickly. Going to summarize Chapter 10 to see where we are. Then I'm going to do a lecture on Chapter 14. And we're going to start this other phase of our learning. I was like studying this morning, and I realized that we're done. I wanted to congratulate everybody. We are done with the hard part of this course. We're not, we're now moving, this is all, now it's going to be more like regular class, like concepts. Sort of just in a way, like intermediate 1 and 2. It's not like the easiest thing, but in a way, like very sort of individual concepts. Like they don't build on top of a 2-month thing anymore. Well, the final exam would have been you would like to discuss it as a community and together as a community. Totally, it's all about. We're all one here. Yeah. So, anything specific? Any questions?
I think just the main point. Vote a hand on non-cumulative final. Only because I really want to.
Voting rights. Voting rights. What? Wait till we get to the limited partnership agreement with the voting rights. No. In a way, in terms of it being cumulative or not. So what I'm doing is I'm gonna put in a question or two, 3 question max on the stuff that we did before. So in a way, because we have 4 chapters only, now I can't put 6 questions from each. I don't have enough material. So it might be 2, 3 questions max on everything we did prior to the midterm. Which was, what, chapter 1 through 4? Yeah. Yeah. Yeah, we'll go over that in a review. We'll really go detailed into the review of that. Yeah, absolutely. Good? Good. You owe me a few extra points on the survey now. You got to go up like 10% now. So, any other community questions, Peter? Yeah, you could be like the student.
I don't think it's a community question, but I sent you another email with the PowerPoint. I know you received one of our group's emails. I don't know if
Dario? Like Dario? Dario?
Yeah.
Yeah, I have it. Yeah.
Okay, so I sent you one individual, correct? One from each?
Yeah, no, but it's fine. I think we already, like, it's fine. Yeah, you're worrying too much. Don't worry so much. Don't. All right, so now we're moving on to worldwide consolidated financials. So this is worldwide consolidated financial statements. So in a way, like what I want to talk about, just to review the topics that we discussed the other time on Tuesday. And the main challenges I want to say again, like with translating the financial statements, is putting together the financials using a foreign currency and really accumulating all these translations in a way that is in accordance with the GAAP. And I just wanted to tell, I was telling the story in my other class, like in a way, like I used to work for this, when I was at UI for 3 years, I worked on the Swiss complex. It was called a fund of funds. And it was like, they came up with a new product in Switzerland back in '96. And they decided to apply portfolio theory. Anybody know like Harry Markovitz's portfolio theory? This very smart guy. He said, don't put all your eggs in one basket. That's called portfolio. In a way, like put little pieces of investments in many places, right? And the theory goes that if you put small pieces of a portfolio in 20 places, the 21st and 22nd and 23rd place you put it in will not increase the risk of the portfolio. In a way, all the risk is already diversified. So the 21st, 22nd, 23rd investment only will have individual risk and not any market risk. So in a way, that's what portfolio theory, how it runs today. So these guys back in '96 in Switzerland, they decided to apply it to hedge fund investments. And what they did was they created this product called, we'll only look for the best hedge funds in the world, and we'll create a basket of them. We'll take 2% of our portfolio and put it in one hedge fund, 2% in another hedge fund, and we'll have 2% across the best hedge funds in the world. And they hired like 100 like amazing Wall Street type analysts to constantly recycle the portfolio to make sure that they only have the best hedge fund pieces in the world. So EY was the auditor from the beginning. Many years went by. I was there from like '05 to '08. And what happened was that this product became very popular. Very popular. And the thing grew tremendously, became a $10 billion fund. Huge. And I was there, and what happened was these guys were very global. They were in Switzerland, New York, Tokyo, and they had funds, a lot of funds from the East. They had a lot of funds from Europe. They had a lot of funds from the US. So some of these funds that I used to work on, they were denominated in three currencies. It was franc, yen, and dollar. USD and euro. So it was four. It was euro, franc, yen, and dollar. And the thing is, because they were taking money in from Japan, Europe, Switzerland, and US, and they were sort of keeping it side by side. They were putting into the hedge funds, but they were keeping the currency in a way, like the reporting in the currency. So I remember we spent a lot of time, like really, like getting really deep into translating the everything into four currencies. I remember it was like. It was every year we were like, it was like trying to explain the FX forward to my manager. It was like, how does this thing lose $800 million? I'm trying to be like, man, listen, I know it's like, this is the real number. Like, I'm like, looked at it 100 times. Because like, all these forwards were running on all the currencies at the same time on a monthly basis. And the forward losses or gains were completely like uncorrelated to the portfolio. So it was always like, nobody could make sense of why the fund is up like 6%. But like somehow the total is -2 because there was such a big currency shift. So in a way, like I remember there was like the partners and everybody was always like really concerned because the FX was really shifting things so much for us that nobody really trusted the numbers. So we ended up looking at the numbers like 100 times because they didn't make sense. All because currency, sometimes the yen-dollar would shift so much in a year that it would almost like wipe out the return or double the return. And for us, in a way, back then, it was like really material like numbers. So we're really nervous about the correctness of all these things. So, this really came up in a way like, how do you translate and how do you apply like the right gap to like make sure that you're applying the right and best gap for each situation, right? So this is sort of what we talked about. And another, I'm going to tell you the most interesting part of the story in a way, like also how the reason this Swiss product grew so much is because this fund of funds, it's called fund of funds, it returned 7-8% every year. Because what happened was that they averaged out the 50 hedge funds, and the average, it was a really interesting financial theory like thing. The average of the 50 hedge funds somehow ended up being always 7-8%. And in a way, that's not a great return because the S&P return over the last 100 years is 7-8%. But the thing is, the S&P has a volatility of 20%, standard deviation of 20%, which means on average, the S&P is 20 above 7 or 20 below 7. And the volatility of this product was 2%. So on average, it was 2 above 7 or 2 below 7. So in a way, they reduced basically the reason this product was such an incredible thing, because they reduced the standard deviation of the return so much by investing in super high risk assets, but in a diversified way. And in a way, that was like a new thing. It was a new invention. And the investors were actually pension funds and insurance funds. The people who really liked this product were actually very conservative investors who were looking for low volatility, high yield product. So it was interesting that it was like it was a hedge fund product, but it fell in the category of high yield, low risk. And I remember I was like one funny thing, seeing like sovereign wealth funds in a way also investing, like some of these places from, I think it was like the Abu Dhabi Investment Authority I saw was in there for some of these investments. So it was like big money coming into these things, but looking for low risk. So just to review, guys, how do you decide the functional currency? Anybody know? How do you figure out the functional currency? What do you think? Yeah, it's basically the one they use most. The one they use most, like primary, exactly. And which one could it be? What are the two options? USD or foreign currency? Or in a way, the foreign is the local. When we say local, we actually mean foreign, because that is the country, the foreign country where we are, where we're operating, right? And home currency is USD for us. That's the language we're using. So if it's a local currency, what is the functional currency is the local currency, then what method do we use? Current method. I'm fired today. And and if it's the USD currency, temporal method. Okay, the other thing I wanted to discuss with you is really, it's also in the homework. I'm sure you guys are really doing the homework already. I know you're way ahead of it. But still, this is the hyperinflation thing regarding in the homework, that there's a clause here regarding highly inflationary economics here. A country has a highly inflationary economy when its cumulative 3-year inflation exceeds 100%. With compounding, it equates to an average of approximately 26% per year for the 3 years in a row. So if it's a highly inflationary economy, then we can use the temporal method even if we're using the local currency as the functional currency. So does anybody know what is a highly, in a way, like what's hyperinflation? Zimbabwe. Right? That's what the last class said. Zimbabwe, right? Any other? What else? What does it mean though? What does it mean when there's hyperinflation? Yeah.
You like basically print so much money that your dollars are worth nothing. There's so many in circulation.
There's so much going on. There's so much in circulation that your dollars are worth nothing. And why do they print, in a way, why do they print so much money? To pay for things, right? To pay for things. To pay for things, right? Exactly. That's really like very perceptive, Mike. Like in a way, like, you know, in the higher echelons of our like economic, financial establishment, like people know, like in a way, like what did they say back in like 2009 or 2010 when the Federal Reserve was doing all those things? They were doing a lot of sort of money supply manipulation. And they were saying, oh, inflation is going to blow up, don't do it. Because they were loaning money to banks, they were loaning money to car companies, they were doing overnight extra loans to banks, you know, and they were, and in a way, when they issue treasury securities, that's also printing money, right? Because back then they were issuing new treasuries a lot, and using that money to buy assets, to buy mortgage backs and buy all this stuff. Basically, we're infusing money into the economy. In a way, that's also called printing money because, you know, you're issuing bonds. You know, what's the asset? The liability. Liability is bond. Asset cash, right? In a way, you just printed money because you issued a bond. That's printing money. So that is a big part of it, in a way. In a way, we're doing it here in an equilibrium. You know, in an equilibrium where we also have a pretty well sophisticated economy, stable interest rates, and things like that. But the thing is that if you're doing something like that, and for example, that was happening a little bit in 2008 with Lehman going down. When people didn't want to trade with Lehman, that's when I remember that. I remember reading the news back then. It was close to getting to that stage here in a way where people were like saying back then on Wall Street at the trading desks back then, people were saying, oh, people were like IMing to each other, don't trade with Lehman today. Because in a way they were like, oh, don't put your money in the bank. And then they were starting to talk about other banks. In a way, that's sort of a hyperinflation when people don't trust the banks anymore and they don't want to save. Because saving is the other side of inflation. Because if you're saving, then there's interest rates and then there's stable like money supply. You know? So in a way, that's like the other side of things where inflation could be very high. But anyways, the reason we use the temporal method instead of the current method during hyperinflation, in a way what we did was we talked about Procter & Gamble with this in my last semester class, because in Venezuela there was a devaluation of their local currency, and P&G was allowed to use the temporal method because of this inflationary economy there. So in a way, the historical method, which is the temporal method, allows you to not bear the losses of this new devaluation. For example, in Venezuela, they had a devaluation as a result of hyperinflation. And what does it mean, devaluation, right? If I'm a U.S. company like Procter & Gamble with Venezuelan assets, and they're going through a devaluation of their currency, is that good or bad for me? Bad for me, right? Because my assets in USD are going to be worth so much less. I'm a USD company, like all of a sudden, I don't know, I just had a power plant there, but now all I know is that I have $300 million loss because this thing is worth half of what it used to be worth. But in a way, is that a real loss? Like if we talk back to reality, is that a real loss or is that some kind of fictional paper loss?
But what if you had to sell? Switch to another method?
If you sell, you realize. If you sell, you realize at the current rate, because then you get out.
You're allowed to hold off.
In a way, that's the temporal method idea, is that you hold on realized loss. if you do have that loss, until you sell. And the whole thing is that if you sell, then you're out. Then you should realize all these losses. That's a great point. In a way, like, we always record this stuff because when we sell, we're going to record it anyway. So the accounting, like, in a way, the method is saying, why not record it now? Because you might sell tomorrow. But the other argument is, like, we may not sell for 20 years. We're never getting out of Venezuela. Then why am I taking a $500 million loss on something that didn't even happen yet? So in a way, the temporal method allows you to defer that.
But you shouldn't be allowed to take gains then either.
Oh, you should, no. On the temporal?
Yeah.
No. I don't think you're...
The currency increases.
If the currency increases in a hyperinflationary economy, you wouldn't be able to, no. But if it's a hyperinflation situation, you wouldn't worry about gains. Because in a way, like, inflation is synonymous with devaluation. I think. Yeah. Unless you have hyperinflation in both countries. And then it's going to equal out. But so that's basically the review. Oh, well, yeah. I think the rest of this, yeah. The only other thing I want you guys to really focus on this, in a way, like the homework and the numerical problems, to really just require you to identify the functional currency, identify the translation method, and then use the chart to figure out which rate you're going to be using. Anybody have any questions, like in terms of rates? So I wanted to talk to you guys about partnership versus corporation, the whole process there. In a way, like, I wanted to approach it from two different perspectives. Like, you know, there's a big, like, business law aspect here, which we'll get into, like, the legal aspect. And then there's a tax aspect that I want to go over also. And then go over the accounting. We'll go over the accounting last. And in a way, I want to approach it like this subject. I know a lot about it because in a way, like, I used to work only at partnerships my whole career, in a way. And one was working at a public accounting firm, which was a partnership, and really amazing way to see how a partnership operates legally and operationally there. And also, when the hedge fund that I started a hedge fund in a way. Also, like, I started a partnership also, and that was legally. I remember working with the lawyers on all the things it takes to make a partnership in a legal way, and why. So, like, I think there's a lot with partnerships that, for some reason, we don't really study on a broad level because most of the big companies are corporations. But in a way, most of the small companies are partnerships. So it's interesting. It's an interesting dichotomy because almost all small companies are partnerships. And it's also interesting that in the service industry, all law firms, accounting firms, and consulting firms are partnerships. So it's interesting. It's interesting from that perspective. There are some really big, powerful firms out there that are partnerships. Like, for example, I can tell you a lot about from personal experience, Ernst & Young. In a way, it was a really big, powerful partnership, a revenue of $15 billion a year about over 100,000 employees around the world, assets and employees pretty much in every major country, in every U.S. state. So it's quite large operation that's being run from a partnership level. And in a way, I wanted to just, like, before even getting to the legal aspect, want to talk a little bit about the management effect that I noticed of being at a partnership rather than a corporation. In a way, I think that since the firm is run, it's a 100,000 person firm, but it's run really by about 1,000 people, 1,000 partners. And I noticed that in a way, like, I think the management of that type of firm is far superior than a management of, like, a corp. Because a corp, like a Coca-Cola, for example, they have their executives. There are 5 really talented executives. But the thing is, those guys are agents of the corporation. And they have the fiduciary duty to do what's for the best of the corp. And a lot of times they don't. That's why we see so many managements get fired almost every other year. And CEOs, high salary 1 year, next year he's somewhere else. and all that kind of stuff that's going on. It's like for hire mercenary type of culture in a way. You go here, I give you more money. You go there, and like all this type of stuff for these execs, as opposed to in EY, it was really different. It was like promote from within. Nobody comes in from the outside. You know, you go from college to partner. That's the program here. You know, you take your 15 years from 22, and then you go there. And then we only promote from within, so we have our own system, and we build from within. And everybody who's in the system has been here for 15 years, and everybody who's in the system owns a part of the system. So it was interesting because those guys, in a way, like owned the firm, ran the firm, and took care of the firm. In a way, I felt like kind of different. It was more, you know, and the thing is, the emphasis was on quality. So that's why I think, you know, like they also invested a lot into a lot of things that I don't see corps doing, like education and benefits. Like they had a whole educational arm, and they trained. They had a whole training for instructors and a whole college basically inside, and a lot of national and worldwide efforts doing different things. So I think in a way, like in a partnership, when I think everybody owns a piece of the business, it's a different culture than a corporation, and it's a different management, like operation-wise. So I thought that was like, you know, I know a lot of you guys are sort of looking at that world, so I wanted to give you a little broader view of that world and what's going on there. So I thought that was interesting. And the other part of that, really, and I also experienced this in my way, is this aspect of liability. You know, there's the aspect of liability, and there's also an aspect of economics. In a way, the big four firms, they can't afford to be corporations, because if they were corporations, you know, on this $10 billion income that they have, 40% right away would go away to the IRS, right? And then their partners would get only $6 billion, and out of that $6 billion, another $3 billion would go to the IRS again. So you'd go from $10 billion to $3 billion in taxes. And in a way, the double taxation of corporation is the reason why the most brilliant tax accountants organize as partnerships. The most brilliant, sort of technically brilliant people clearly are recommending partnership, because you can keep, instead of keeping 30 cents for every dollar you earn, you're keeping more, I think you're keeping more like 68, 70, 71. Maybe 75 if you're really good. I don't know how good your accountant is. But the idea is like you can really like, you know, if you go from 30 cents to 75 cents or 30 cents to 70 cents, look at what you're doing. You're basically, your income goes up by about 220%. So look at the way tax structure goes and the impact on net income. 200%, 220% income change from the organizational level. Now, this is really not an accident, and the idea is that what they're doing, in a way, by doing that, is that they're taking on liability. They're taking on liability. And in the Big Four world, in the audit world, in a way, you have to have that liability. You have to have that liability. Because if you don't bear the lawsuit liability, you're not going to have the quality that you want. So in a way, it's like a dance between, you know, taking on a risk and also taking on the benefit of carrying the risk. You know, they take on the risk and they sort of absorb it, and they make their money, that they make quite a bit of money, but they also, you know, I think by taking on this audit risk that they take on, they also find a way to really evolve. I think they really evolve how to do accounting in an efficient way, which is an incredible thing. I think a lot of, you know, what are usually the complaints about accountants or business people is that they're bureaucratic or inefficient. But in a way, in the Big Four world, that doesn't really exist because they're so aggressive regarding efficiency. I mean, this could be good or bad, but so that's part of that world in terms of liability and taxes. And in a way, like, just wanted to go over the advantages and the disadvantages of a partnership. You know, and the tax benefits are really clear. So the disadvantage is unlimited liability recorded by the partners. So in this world, basically, it's a really exciting thing to be, like, for example, a Big Four partner, right? One thing is exciting is that you're making hundreds of thousands of dollars. That is a nice thing. The thing that's really, I found really insane about those guys is that they are so incredibly busy because their name goes on all these financial statements. And the thing is, your name being on the financial statement, basically you're attracting a lot of risk. Like, you're attracting a lot of risk because anything, and remember, like, having a lot of these high-level meetings there, the thing that on the higher levels in the management that auditors are looking at is always liability. And the liability comes in terms of errors. They always try to see the potential of errors before they come. That's basically their business. And on the higher levels, when they start seeing the potential of errors in a business, they start getting really nervous. Like, because like, what are we gonna do? We gotta do a lot of work. How do we do the work? There are methods, there are ways. And that's basically the liability. And there's a chain of support because you don't want this error to get to the partner, so they have a lot of levels that prevent errors from getting all the way up there. But that's the unlimited liability. I remember being in meetings, these people are just yelling and they're livid because they're just pissed off at the poor quality of the work. If they find an error that made it all the way up there, and now they're looking at it and they're like, this is freaking unbelievable. Like, I'm about to sign off on this thing and it's wrong. Like, this is like my life, my house. Like, we're about to publish this thing. I remember, like, sometimes we, like, printed the financials already and then we find something, we're like, no, get these back to me, we got to fix them. So it's like, in a way, it's like this sort of chasing errors in a way, and also like trying to prevent a lawsuit. And in a way, you don't know, like, when you're in the world of the financial statements, the error and the misstatement can come from anywhere. Like, you don't know. All you know is that you know that if there's any error at all, the liability comes in, because there's lawyers on the other side of the world that are looking for these things, and they're very aggressive in terms of coming after you. So you're sort of, in a way, that's why you can't have any spaces, you can't have any commas in the wrong place, you can't have any decimal, like, in a way, like, it's very rigorous in terms of having everything correct, because it's more like a attitude toward everything. But that's basically the unlimited liability. In a way, like, I think that creates, I think there's a beautiful thing about it, because it creates this desire for quality. And I think sort of through this liability and this, like, it's like a dance, through this risk, there's this incredible amount of quality that comes through and methods that are really efficient. So that's sort of the disadvantage in a way. Because on the corporate side, do you think like BP or Exxon could ever be partnerships? No, right? Because it's a different type of business. In BP or Exxon, you couldn't get those guys to be partners. Because would you want to be a partner at BP? You're sleeping over there, you're married, you have a house, 4 kids, and there's a tanker out there somewhere, and it crashed. And you get a call, and you're like, man, listen, like, you gotta clean this up, man. Like, what? It's like, I didn't do it. I didn't do it. Well, you didn't do it, but you're a partner, and all these things, so your name and your signature. So the idea is that, you can't really, that's too much liability, no? That's too much. You're not comfortable with that. Not comfortable. I wouldn't be comfortable. Maybe you're comfortable. Yeah.
Does the partner get sued directly, so he doesn't have any trouble like corporations?
I mean, they actually have a lot of protection for them, because in a way, the lawsuit action always comes at the firm first, because they want to get money, and the firm has a lot of money. They don't have really, but they also name the partner in every legal action. They also name the partner. You know what I mean? And if the legal action goes through against the firm, which it could, and the firm can bear that because they have a huge insurance fund. They don't care about lawsuits. They're in the business of dealing with lawsuits. But on the partner level, that could be a detriment. And they have this liability insurance, and I think they have protection layers. But still, as a partner, you're not gonna want to do stupid things. In a way, like you're gonna feel it if you make errors, like you're gonna feel it quickly. So in a way, that's the culture. But there's the sort of the economic part of it, the tax aspect, and there's the legal aspect of it. That is also like, you know, a big part, and it has to do with liability. And we'll get and the accounting we'll get into in a little bit. And in a way, like when you're seeing like a lot of this sort of talk about in business law and law about this whole LP, LLP, LLC, and S corp, and then in the Caymans it's called limited company. I used to work with Cayman Islands a lot, but in a way, every country, like we used to have the Irish, the European, the Cayman Island, every country has a pass-through, like way of passing through income. In a way, a lot of it's available around the world. It's basically a way to pass through income, a flow through entities. This is basically LP, LLC, LLP, and S corp are all terminology on how to have a business that doesn't get taxed. And this is the whole idea behind all these businesses, in a way, like to not pay tax at the business level. If you ever sort of form a business, in all likelihood, that business will be a limited company, with a limited corporation or an S corp or a limited partnership, because you want to, in a way, avoid double taxation as much as possible. You want to avoid double taxation as much as possible. This is sort of the general rule of why all investment vehicles are organized as partnerships, in a way. That's just the culture of the investment world, because the investment world doesn't want anything to do with taxes at its entity, because it just does a service. It's not doing a business. So everything is basically passed through. And does anybody have any experience with pass-through entities, in a way? Working like being a partner in a partnership or anything like that? Oh, interesting. Sort of like keeping their money abroad like that.
And in like 250
Around the world. That's how they keep their cash. That's interesting, yeah. 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 You notice that there's a whole sort of world out there. I definitely saw it in working in the private equity business. In a way, like, it's like how to keep money offshore. And like... Yeah, well, I mean, I think in a way, I think there's confusion. There's confusion in that word, because I think you say the word offshore and people automatically think it's tax evasion. But in a way, it's basically storing money that is foreign money in offshore accounts, rather than not paying taxes on U.S. income. There's two. If it had come here. Right. Yeah, we do that. Yeah, that's why, in a way, like, I remember we used to work with that extensive. I mean, like, in a way, in the investment world, there's always two vehicles for every vehicle. There's a U.S. vehicle and there's a Cayman vehicle. And we always, in my partnership that I set up for the hedge fund, we also had, we had Cayman vehicles, because foreign, like European investors who want to get exposure to U.S. type stuff, they get exposure to it through the Cayman Islands without ever touching U.S. money, U.S. soil. And then the income gets allocated back to them without going through the U.S. K1. So the IRS doesn't get, you know what I mean? But, yeah, that's basically a way. A lot of companies are using a lot of different ways of sort of moving money around so it doesn't get, like, you know, allocated. But it's a complicated world with that. It's an interesting world, though. In a way, it's like an interesting world of what's going on with tax structures and income, and a lot of corporate lawyers are involved with that. You'd be surprised. Like, I remember I used to have this, when I used to work at Tiger, I used to have these lawyers, Ropes and Gray, and like call them. I'd have these like complicated questions regarding the stuff, And I would call them, and I didn't like the first month. I didn't realize they're charging me like $1,000 an hour. Like they're so nice to you. I'm like, oh really? That's how it works, the Cayman thing? And then we put it there. Oh, and that's how. Then I get a bill from this guy for like $1,500. I was like, what? You charge me $1,500 for that? Like they're very nice to you, but they're very expensive.
Why can't Coca-Cola be an LLC and avoid taxes?
I mean, in a way, because there's so much liability that they're dealing with. If like somebody Coke explodes somewhere, or what happens, like there's a truck out there somewhere and like gets hit by something, or, in a way, I think that there's so much going on with like manufacturing, with lawsuits and employee, probably labor lawsuits too, that partners wouldn't want to deal with. Or it's even if you look at it, the culture of Coca-Cola, it's not even organized like that. And I think it goes to the seed level actually. Like they actually have always wanted to have this separation between like the people and the management. As opposed to in partnerships, there's no separation between the people and the management. It's basically one unit. And in a corporation, in a way, like if you work for a corp, who are you really working for? You don't really know them. You're like, it's some people out there, and they're out there, and who are they? It's not in the bad way. I'm just saying, like, it's been even organized that way. As opposed to these large partnerships, they have different layers of different things that work. I don't know, like, you know what I mean? It's almost like that organizational document. So this is all passed through. And now talking about the articles, the purpose of the articles of the partnership, and the purpose of the article of incorporation of the partnership legal document, the LPA. Basically, this document describes all the legal aspects of the partnership. In other words, who is the partner, how much are the income they're getting allocated, how much loss they're getting allocated, when they can withdraw, when can they come in, is there any bonus allocation, is there any kind of special rules regarding the partnership. So this is a very important document, and I remember in a way, like also like in the world of audit, higher level auditors at EY, in a way, like what I used to do also is, since I've already seen a lot of these, I've seen like so many of them throughout my life that by the time I was year 3, 4, 5, sort of using the legal document, you would gain leverage in challenging the client's books and records. In a way, as a job of like a manager, auditor, you basically want to produce, in a way, your production depends on finding errors. And the best way, in a way, like in the asset management world, was the very experienced people, performers, used legal language to find errors in the books and records or in the whole entire concept, the way the client is doing things. So in a way, like, you would know the legal agreement so well as the auditor, you would know it better than the client, and then you would attack their books and records in a way and be like, oh, listen, you're doing this, and it's not in accordance with Section 714, because your legal document says you should be doing it this way. And that's where, you in a way, like, produce a big benefit, because you would find something that is not in accordance with the legal document. In a way, that's how you create value for the client, because you've basically found something that's intimately wrong with their books based on the legal language. And this is something that we used to do a lot. That's why, in a way, like, a lot of senior auditors, you meet with them, they're very well familiar with the legal framework of everything. Because in a way, in the upper echelons, everything involves the legality of the situation. Because in a way, like, you want to know GAAP also, but on a legal level, but also the legal system that the client is trying to adhere to. Because it's more of a compliance review. So from a compliance level, you sort of change things around. And I remember, in a way, like, using some language several times to really force the client to make multi-million-dollar adjustments. just proving to them on a legal basis, using their own legal language that they're not familiar with, and really like leveraging a big adjustment. I remember we went through a project where we leveraged like a several $million client audit adjustment from work that I did with my team, and we sort of got the support of our management and then later their management to do this thing, because we found out that according to their very complex legal language, we modeled out the math, and our math was way different than their math. And we sort of pushed it down there using legal language and then supporting with the math. And in a way, like, that's the kind of production that gets a lot of people's attention at a firm. You know, when you produce something like that where, you know, you're really like, you know, the immediate client accountant might be mad at you, and the CFO might be mad at you, like a little mad at you. But in a way, like, the CEO of the company will appreciate that, because the top management of your client wants compliance over their accounting team. So in a way, like, when you reach out that high, you get the attention of like really the top management, because they're saying, now look, the auditors know more than our accounting team, and they're finding errors that are helping us. And although it's embarrassing for the client in a way, a little bit, they appreciate it, because it looks like basically, we knew their documents way better than they did. And that's just basically because, you know, the leverage and the experience of the team sometimes on the public accounting firm is way better than on the private firm. And in a way, that shows in some of this production. So in a way, like, I spent a lot of time really learning these legal documents, how to leverage them to make a move that will create value for our firm and a way for their firm. Yeah. There's not really a lawyer, but in a way, like, the people who are like managers and senior managers and partners, they're so well versed in the legality of everything, because those guys essentially just spend time writing these research memos that are all legal based, basically. And they're more like lawyers than anything accounting related. They don't really deal so much with numbers. Like, they can do the numbers super quick and all that, but they're more like, oh, this is the legal thing here, and according to this section of that is this. They're more engaged on that level. And I remember in my 5th year there, it was more like that. It was more like editing the legal language everywhere, not really doing numbers so much. It was still like, still have to foot down the financial, like, you still have to foot everything. But in a way, you're really modifying like the legal aspect of everything. Because it's like the more and more you move on, the more you start realizing that it's about sort of phrasing things in the right way. So this is basically the info that goes in there, the rights and responsibilities of each partner, the contributions, any kind of liquidity aspects, procedures for admitting new partners, arbitrating disputes. I've seen a lot of issues with this, where it's like somebody doesn't want to recontribute to the fund when everybody's raising a contribution. Somebody says no. Like, there's issues. Life insurance provisions, there's always issues when a partner gets deceased. There's like a transfer of ownership and a rebalancing of ownership. So settling the business upon withdrawal, retirement, or death. In a way, it's also like a big clause, like anything can happen. So if like the GP is deceased, who takes over that piece, and what kind of control will they have? So it's sort of, a lot of these clauses end up being really big. Like lockup procedures, I remember in 2008, there was a liquidity crisis and everybody wanted to take their money out of hedge funds. But hedge funds were like, listen, we have the ability to lock up your contribution for 2 years. It was just a clause in the agreement, and everybody went berserk because they're like, I didn't know about that. But in a way, these things come up that are very important. People were livid. They couldn't take their money out, and the hedge funds stood their ground. They're like, no, legally you can't touch the money right now. Like, this is it. And in a way, it was sort of a standoff between, because once you start challenging, you can't challenge the legal document. Once the language is clear, it's clear. And a lot of disputes can happen coming from these, but people will stand their ground according to the legal document. So in a way, that's why when you're starting a partnership, you have to be very careful drafting this thing up. You have to really make sure that it's like that everything that needs to go in there goes in there. So it's like a big